Financially raw, real, authentic wisdom with Lourens from Retire Rich and Happy.
Good morning, everyone, and welcome to another episode of Financially Raw. Financially Raw, as you all know, stands for real, authentic wisdom. So we're going to talk about things that has an impact in your life, and I'm not going to mess around. I'm going to say it as it is. Is it a good idea? Isn't it a good idea? And looking forward to spending the next hour or so with you guys in studio. Those of you who are listening online on bergstudio.co.za, welcome, and I'm looking forward to sharing this time with you. You are welcome to give me a shout out. You'll see on the button or on the website there's a little shout out button at the top. You can press that, send me a message, ask me a question, and I will be happy to answer that questions for you. Also, if you are watching on one of our social media channels, Facebook, YouTube, LinkedIn, you are welcome to send me a WhatsApp if you have any questions. I have my WhatsApp open here next to me. And my number is on the screen, 082-801-6693. You're welcome to ask me any questions. Make a comment. If you don't agree with me, if you do agree with me, that's also okay. You can send me any questions you want. I will answer them. Also, today on Berg Studio, we have artists or a band that is our band for the week. And today I chose Prime Circle, one of my all-time favorite bands from South Africa. I really, really do love their music. Unfortunately, those of you who are on our social media channels, we can't play you the music. So while we are playing music, we are going to show you a video of one of our previous shows on how life insurance works, seeing that we have spoken or that we are speaking about life insurance today. So what are we talking about today? It's an article that I'm going to run through with you that was posted on MoneyWeb, a website that discusses all things money. And the article asks the question, should I cancel my life assurance and rather take the money that I'm spending there and invest it instead of paying it into risk cover? And risk cover, if for those of you who know me, I call what if money. It is money that you pay a third party for in case something happens to you. Doesn't create an asset, doesn't build anything unless one of those eventualities happens. So we always teach people that you want to keep your expense or your expenses towards what if money as low as possible and have as much money as possible for investing. But the question is, should you just cancel your life insurance and then go and invest that money rather? So without further ado, let's start with our first music break, and we're going to play you some music from Prime Circle, and I think it's probably their most well-known song called Hello. And for those of you on our YouTube channels and all our other social media, let's have a look at how life insurance works. I don't care what the big companies try and the marketing guys at these companies try and sell you on the idea that, oh, but if you do this for that many years, we'll give you this back and you'll get some of your premiums or all of your premiums back. That is all marketing bullshit. That is what it is. Because all they're doing is they are charging you more for the insurance that you're taking out, and that extra money gets kept by them. And if you then jump through all their hoops, through all their rules and regulations, they will then give your own money back to you.
Financially raw, real, authentic wisdom with Lourens from Retire Rich and Happy.
So, firstly, our topic for today, Today I thought I'm going to talk to you about why it is important to review your life insurance. And we're going to talk a little bit around life insurance, what you need to know, what you need to look at. If there's any questions, you are welcome to give us a shout out on the website. Please chat to me. I'm alone in studio today, so talk to me, keep me company, ask me questions. I'll be happy to answer those questions for you. Also, if you want to follow us, you can follow us on YouTube. You can just search for I Retire. Facebook's Retire Rich and Happy, and then our website retirehappy.co.za. On the website, you will also see a link to register for our coaching webinar, which you can attend every Tuesday evening at 7. Just follow us, give us a shout out, and I look forward to the hour that we're going to spend with you. So like I said, today we're going to talk about why you need to review your life insurance. So the first thing I want to chat about is, what do I mean by life insurance? Because too many people think life insurance is, when I die, there needs to be money for my family. But I don't have children, so I don't need life insurance. So the first thing you guys need to understand is that life insurance is not life cover. It's not the same thing. Life cover is a type of life insurance that will pay to beneficiaries in the event of your death. But life insurance as a total definition is any insurance you take out on what happens to you in your life. So that includes things like you getting cancer or you getting into a car accident and becoming disabled. That is all part of life insurance. So just keep that in mind. Life insurance is not life cover. Life cover is just a portion of life insurance. So I believe that every adult earning an income needs some kind of life insurance. You might not necessarily need life cover, but you need some kind of life insurance, because the moment you become an adult, the moment you start looking after yourself financially, you need to start minimizing your risk so that if anything happens, that your life or your dependents' lives, if you have dependents by that time, can continue in the same manner as it was used to. Welcome back, everyone, and that was Prime Circle with Hello on our Berg Studio. If you want to go listen to the music and not watch a video of me halfway through, and then you are welcome to go to bergstudio.co.za. It is an online radio station, and it plays some brilliant music, a lot of hard rock music, a lot of metal. So if you're into that kind of thing, you can definitely put Berg Studio into one of your favorites and go and listen 24 hours. So we're going to talk about should you cancel your life insurance and rather save that money or invest that money. So let's start running through the article, and as we go through, I will give my comments and tell you what my thoughts are. I must be honest, I'm very happy with some of the advice that Marius Fenwick, who wrote the article, put in here. So I agree with most of what Marius is saying, but I'll add to it and expand a little bit upon this. This was done on the 21st of September, so it was just a couple of weeks ago. It says, my husband and I are in our early 50s. I've been a stay-at-home mom for at least 22 years. Our oldest daughter is finishing university, with our second daughter currently in matric. We will also be able to pay her university fees with no problem. Our house was paid off in our first 5 years of marriage, and we always believe in buying everything cash. We are fortunate to have had investments, pensions, annuities, and money markets over the years. My husband is thinking of cancelling our life insurance of 10,000 Rand a month. He thinks we can invest this elsewhere. Is this a wise decision? Now, before I get into Marius's answer, it's always such a difficult thing to answer a question like this, because although there's a lot of information that the client does give, it is still a very difficult thing if you don't do a full assessment. We call it a risk assessment, And it is so important to have that risk assessment done, because it's not just about we don't have any debt. It's not just about we are in our 50s or we are close to retirement. It's all about what are your actual needs. And the only way to do that and to determine those needs is to do a proper risk assessment. So let's see what Marius has to say. He says, I noticed that you referred to having no debt and that all your purchases are made in cash. You also referred to having, just quickly on that point, a lot of people refer that they have no debt the moment they've paid off their house and they don't have credit cards or store accounts. But sometimes, or a lot of times, I see that those same people have car debt. They have a vehicle debt. They might have a caravan or something like that, which they sort of don't see as debt. So when we talk about all purchases are made in cash, we need to look at is the cars paid cash and those things as well, all paid off. In this case, we assume that they have zero debt. So you also referred to having substantial investments and savings. I would like to commend you on this. You have stuck to the very basic principles of financial planning, namely to keep the debt to the minimum and focus on investing as much as possible as soon as possible. And I agree 100% with him. Your biggest killer is specifically your unsecured debt. Those are the credit cards, the personal loans, the overdrafts, the store accounts. Those are what kills your cash flow. And if you can, from very young, or when you start with your planning and when you start working, keep that to the absolute minimum and invest as much of your money as possible, you are already on the right track. Where you invest is less important. Don't read not important, read less important than when you actually start investing. And that is also true in the sense that the earlier you start with your investments, the more time you have for compound interest to work to your benefit. The longer you start, even if you get an investment that performs better than the ones that you put the money in the beginning, it will be very difficult for you to catch up to those early investments. That's also one of the reasons why we very, very seldom suggest to people to cancel one investment to start another investment. We see it a lot of times where a person has something like a retirement annuity, for example, and then after a few years, the financial advisor comes and he says, no, we can put you into this fund, and it's giving us, or this company, we can move you from this one company to the next company, and it will give you a better return on investment. The problem is you can't buy the time back. So now suddenly you are paying penalty fees, you are paying all of those fees on moving the investment, you are paying new fees on the new investment, and that money takes away from that compounding effect that you have built up. So be very careful when a financial advisor comes and says to cancel one investment and move it to another investment. He continues, he says, those who start investing early in life have the benefit of experiencing the power of compound interest. They will have to invest less over time than those who delay investing, and their cash flow will not be pressured later in life. Now, I agree with the first part. The second part, not so much. The reality of the situation is, even if you start investing at an early age, savings alone is not the answer. So just saying that you have invested or started investing earlier in your life does not necessarily mean that your cash flow won't be under pressure later in life. You need to have different assets that you invest in. You need to build different asset classes that you invest in. Generally, one starts your career and a family with limited assets. And that's something we talk about quite a lot because the kind of assets that we are taught to retire with is called capital assets. You save money into some investment vehicle, a retirement annuity, your pension at work. You work your whole life, you get to retirement, the money pays out, you invest the money. Usually with most people, 96% of people, the money run out before they run out, and then their children starts with zero. They build throughout their life, save enough money, retire at 65, money runs out before they run out, and their children start at zero, and that cycle just continues. So typically that's the situation you would have been in as well. You started your career, started your family with limited assets. What we teach is, instead of just focusing on capital assets, you want to build business assets and fixed assets as well. And those kind of assets that generate income, we call them income generating assets. Those assets will go on after you pass away and go to your children, so that your children can inherit those assets. They don't start from zero like you started from zero. Okay, so during the early phases of one's working career, debt is higher than later in life due to home loans, car finance, baby expenses, education costs, etc. During these times, the requirement for life assurance reaches a peak. Now, this is again a very true statement, because as you are a young adult, newly married, you have children at school, your need for life insurance is at its highest peak. So as one's investment portfolio gains structure and value, the requirement for life assurance reduces. Okay, so that is a true statement. And this is one of my issues with some of the insurance companies out there. I'm not going to name names, but they promise all these paybacks and bonuses and all of these kind of things. The problem with that is that they are basically linking those paybacks to you keeping the same amount of life insurance for the rest of your life. So if you have 5 million life assurance now, or 10 million life cover, that 10 million life cover has to stay there at age 65 for you to get your benefits and your bonuses. And it's like swimming across a dam. Once you're in the middle of the dam, you can't turn back because you're too far, and you can't go forward, you're too far, you're going to drown. And that's what happens with a lot of these companies. They get you into that situation with their promises of the bonuses and all of these kind of things, and then you basically cannot reduce your life cover. Otherwise, it negatively influences your retirement, because they've tied your retirement into your risk cover. So I've got a major issue with that way of financial planning. You do not tie your retirement investment to your life cover. It should be two completely separate things, so that you have life cover for the needs that you have. No more, no less. You need to make sure that if anything happens to you, you and your dependents' lives can continue in the same manner as they are used to. So don't get caught up in all these bonuses, and they're going to pay you a portion of the life cover when you get to 65 and blah, 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 blah. The problem with that is, for a long period, you are going to pay for life cover that you don't need. And that is important to understand. Okay, there are exceptions where insurance requirements can be very high later in life. For instance, when a business is bought or expanded and life assurance is required as surety. But I'm not going to delve into those specific requirements for now. Before one purchases or cancels life assurance, you need to determine what you need the insurance for and how much you need. So this is the basis of everything we do in our financial services provider, RRH, or Retire Rich and Happy, because everything has to be needs-based. What is the amount of cover that you actually need? Not how can we get you more cover for the same premium, or get you to pay less for the cover that you have. That is not the way you approach life insurance. It's not the way you approach disability, dread disease, any of the life assurance benefits. You approach it from what it is that you need. So what I'm going to do is we're going to take a short music break. For those of you who are listening online, we're going to listen to some more Prime Circle. And then when I come back, we're going to continue and explore a few of the reasons why one should have life insurance. And then we'll continue this discussion. Those of you who are watching on our social media, we're going to continue our video on how life insurance works. So I get to so many clients, and when we talk about taking out life insurance, and we talk about spending 1,000 Rand or spending 500 Rand or 2,000 Rand or whatever the case may be on their life insurance, they sort of back off, and it's like, no, geez, that's so much money to spend on life insurance. But that same person is spending 3,000-4,000 Rand a month on their short-term insurance, their car and household insurance. And the story I usually tell is the story about the goose that lays the golden eggs. If you had a goose and every morning the goose laid another golden egg, and you can go sell that egg and use that the money from that egg to support your lifestyle, to pay for your house, etc., etc. What would you insure? Would you insure the goose, or would you insure the eggs that the goose lay? And the obvious answer is, of course I'll insure the goose. Why would I insure the egg? Because if the egg breaks or gets stolen, I can always get another egg from the goose. But if the goose is gone, then there's no more eggs. And then we look at what we look at in our own personal capacity. You are the goose that lays the golden eggs. You go to work, you do something to generate income for the family, to make sure that the family is looked after and can maintain their standard of living. But then we spend thousands and thousands and thousands to insure the eggs, but we don't insure the goose. So don't fall in that trap where you spend more money insuring the eggs than you do insuring the goose. But saying all of that, there's a very important thing that you need to keep in mind, and that is how you need to approach your life insurance. Unfortunately, for generations, the approach to life insurance from advisors, from brokers, from financial advisors, or whatever these guys call themselves, the approach has been to try and beat what you've got. And that is exactly the wrong approach, because then you do not know what you are actually paying for. I usually say most of the time people pay for these things on hope. And the purpose is to move you from hope to surety. You need to know what you are covered for and what you are not covered for. So you need to understand it. So the approach typically is to beat what you've got. So what typically happens is a person comes and sees you, and they look at the first thing they say is, let's have a look at what you've got. And they'll say, well, we see that you have 3 million life cover with company A. We can give you 3.2 million life cover with company B, and then we're going to give you this bell and this whistle and this little bonus back if you jump through this hoop or whatever they try and sell you on. And then you go, well, it's 3.2 million life cover instead of 3 million life cover. That sounds like a good deal, and you move. But the question isn't whether 3.2 million was better than 3. It was, did you need 3 million Rand in the first place? Why do you have 3 million Rands worth of life cover? Is it enough? Is it too much? Is it too little? What does it actually mean? So the approach to your life insurance must always be not what have you got, but what do you need first? That's the first question you need to ask. Before you even look at life insurance, you need to first ask yourself the question, what is it that I need? And only once you've determined what you need, you then build something that does exactly that. No more, no less. Because everything that you spend into life insurance is called what-if money. It's money that you pay a third party, some insurance company, for in case something happens to you. This money doesn't build up an asset value. It doesn't build up a cash value. It doesn't come back to you unless one of these eventualities happen. I don't care what the big companies try and the marketing go. Welcome back, everyone, and that was Prime Circle, Let Me Go. For those of you who are watching or listening on Berg Stereo, for those of you who are watching on our social media channels, the video that I'm showing, we're not going to go through everything there. It's like, I think it's just over an hour. So if you want to watch the rest of that video, you're welcome to go to our YouTube channel. It is Retire Happy, or you can just search for I Retire on our YouTube channel, and then also you can search for Financially Raw. You will find us as well. Like and subscribe. I think we've got 190 different videos on there with a range of topics, anything from short-term insurance to saving, investment, how the financial coaching works. So really you will find something interesting there. And yeah, if you like and follow, it does help us a lot to get this message out to as many people as possible. Again, if you have any questions, you're welcome to give me a shout out on the radio. Also, you're welcome to send me a WhatsApp. My number is on the screen. And if you are on Facebook, you can just comment directly on Facebook. I will see it. I've got it open here underneath the screen. All right, guys, let's continue with our discussion on should you cancel your life insurance and rather invest the premium. So when we ended, I said let's explore a few reasons why one should have life insurance, or should I rather say capital. Life insurance is only required to cover the shortfall of the capital that you have available to meet certain demands or wishes. There are many circumstances to take into consideration when deciding on life insurance. The following come to mind, but the list can be extensive. So reasons why you should have life insurance. So there's different ones: disability, severe illness, that's other discussions. Let's talk about the life insurance side. So to provide capital to your surviving family should you die. If the breadwinner dies, their spouse and children need funding to maintain their standard of living and cover day-to-day expenses. And that is something that people need to keep in mind. So if you pass away tomorrow, your ability to generate an income and help your family survive financially falls away. But the need for that income does not fall away. So you need to look at how much income your family would need in the event that you are not there to provide it for them. Should a person lose the ability to earn an income through an injury or illness, capital is required to replace the income either temporarily or permanently. Capital in this case can either be as an insured lump sum or a monthly payout by the insurer. So that is not 100% accurate because if it's a temporary disability, let's say for example you get into a car accident and you're in hospital for 6 months recovering, you cannot work and your company will stop paying your income. That does not mean your capital disability will pay out, because capital disability only pays out on permanency. So if it's a temporary disability, capital is not going to solve that temporary problem. You have to look at an income protection in that case. So it's not as simple as saying you choose either capital or income. It is a combination. We believe that you should have capital and income to make certain you are sorted out in the event of a disability. In the event of death, various expenses become payable. For example, debts need to be settled. The bonds, the vehicles, the overdrafts, credit cards, things that you sign surety for, whether it's through your business, all of those debts need to be made provision for. Also paying your death duties and executors' fees. Now, that is something that a lot of people underestimate completely. The amount that it will cost to actually wind up the estate, the cost of dying. A lot of people think it's only executors' fees, but there's a lot more involved than that. It is the transfer of any assets into the beneficiaries' names. It includes things like the setting up of a trust and the running of that trust for many years if your children are still young. And those costs can very quickly eat up the value of your estate. So you need to make provision for that in your estate. Where there is sufficient capital, liquidity available to service expenses in the estate of a deceased, assets, there's a bit of a spelling mistake there, diseased, not deceased. So yeah, I don't know how many proofreaders this went through, but anyway, so that needs to say deceased, not diseased. Estate of a deceased, assets will be sold to cover the cost. Life insurance can play a vital role to prevent the unwanted or forced sale of assets within the estate. So this is something that I see a lot. People don't have enough life cover to pay into the estate to make sure that the liabilities in the estate is covered. Therefore, the executor of the estate has to then sell the assets. And that's where you get this insolvent estate auctions, where, remember, the executor is not there to get the closest market value for that asset. They just need to make the estate solvent. So they will sell for whatever offer they get, which means that your dependents will not necessarily get the value of the asset. So it's always so important to have enough capital in your estate. So the main question is, how much life assurance is needed, if any? Now, here I want to stand still a little bit, but I'm going to read through his paragraph first. It says, earlier on, I referred to life assurance as available capital, and that is exactly how it should be viewed. What we must accept is that life assurance is a grudge purchase. Very few people wake up in the morning and will, with a stretch, yell, today I'm going to buy some life insurance. Yay. And that is the truth. Not a lot of people, and most people have that thinking in their head that I am okay, I've got some life cover, or my pension fund has some group life cover. Surely I'll be okay if my wife gets 3 million rand. Because people overestimate the value of capital. Life assurance must therefore be justifiable and measurable. So this is the important thing. If you have 3 million life cover currently, and a broker or financial advisor comes and says to you, he can give you 3.2 million life cover for the same premium, then it's not in your best interest. Although you are paying the same amount for more life cover, what does that life cover mean? Is it enough? Is it too much? Is it too little? Why do you have that life cover? And that is the important question. Why? Why do I have this amount of life cover in my estate? If you can't say, I have this amount of life cover, I've now got 3.2 million life cover, because 1.2 million life cover will go into my estate to pay off all my costs of the estate. That leaves me with 2 million. 500,000 of that will be invested for my children's education, and the other 1.5 will be invested to give my wife an extra 3,000 rand per month. If you can't say it in that way, then you don't know why you have your life cover. So it has to be justifiable and it has to be measurable. Otherwise, it stands to be cancelled as soon as cash flow constraints set in. Every person should therefore also know exactly what the implications will be when they decide to cancel life assurance. And guys, that is all about focusing on life assurance from an education perspective, from a needs perspective, not from a what have you got perspective and let's try and beat what you've got. Interestingly, the average person would rather insure their car and household goods than their own life. When asked why, they state in case they are in an accident or theft, they need to have that cover. My question is always, what are the chances of you being in an accident or losing your car due to theft? And what are your chances of dying? I think the odds favor life assurance as a potential claim. So I hear his argument. The problem with that argument is that a lot of people, there's no urgency in that argument. So yes, you have a 100% chance of dying. You might have, in South Africa, a 30 to 40% chance that at some point in the next couple of years, you're going to have an accident or your car or something is going to get stolen. And that's the problem. It's the time delay effect. People think that, I'm only going to die in 50 years, 60 years, 70 years. It's not going to be something I'm worried about at the moment. When I come back, we're going to go for another music break. And when I come back, I'm going to share with you my explanation on why it is important for you to have your life cover and why you have to look at it differently than just saying, I need my stuff insured, my car and my household goods. So let's take another short music break. We're going to listen to some more Prime Circle, our band for the day. And this is She Always Get What She Wants. And those of you watching on our social media channels, let's continue with our video on how life insurance works. Guys at these companies try and sell you on the idea that, oh, but if you do this for that many years, we'll give you this back and you'll get some of your premiums or all of your premiums back. That is all marketing bullshit. That is what it is. Because all they're doing is they are charging you more for the insurance that you're taking out, and that extra money gets kept by them. And if you then jump through all their hoops, through all their rules and regulations, they will then give your own money back to you. It's not like the insurance part of the policy actually comes back to you. The insurance part that you pay for is gone the moment you pay for it. So let me quickly explain how insurance works in simplistic terms. Insurance is basically a gambling arrangement between you and the insurance company. How it works is like this. You go to the insurance company and you say to them, listen, I think I'm going to die this month. That's what I think. The insurance company, okay, I'm listening. And then you go and you say, so I'm willing to bet 500 Rand that I'm going to die this month. But if I'm right, you're going to pay my family 3 million Rand for the 500 Rand that I've bet. The insurance company then looks at your health situation, they look at the risks involved in your job, everything related to you, and they say, well, okay, we'll take that bet. If you die this month, we will pay your family 3 million Rand, but if you don't, we keep the 500 Rand. You then put your 500 Rand on the table, they put their 3 million Rand on the table, and then we go through the month. At the end of the month, you haven't died, and then the insurance company goes, great, we won this bet, and they take your 500 Rand. And then they say, well, would you like to take this bet again? And then you go, yes, I think this month I'm going to die. And then you repeat that process. And that is, in simplistic terms, how insurance works. This thing that the insurance company will say, we'll take the bet, and then you lose the bet, and then they just give your money back to you, is utter and complete nonsense. You need to understand that. It's utter and complete nonsense. It is extra. So what the insurance company does is they say, well, we'll take the bet for 500, but if you pay us 700 Rand, we will keep the extra 200 Rand on your behalf and pay that back to you if you follow the rules that we have set out. Now, I don't know about you guys, but I would rather keep that 200 Rand in my account, invested in my investments the way I want to, instead of giving it to an insurance company and waiting for them to give it back to me. That's just me. If that is what you want to do with your money, by all means. But for me, I want to have control over my own money. So there's a few different areas that we need to insure. So there's primary risk areas and there is secondary risk areas. The primary risk areas are the most important parts that needs to be insured. So what I see so often is I sit with a client over the 22 years that I've been in the industry. I sit with a client and then the client he's spending 500, 600, 700 Rand a month on a whole bunch of secondary risk areas. But his primary risk areas isn't sorted out yet. And then, welcome back, everyone. Those of you watching on social media, that is how life insurance works. If you want to watch the rest of that video, you're welcome to go to our YouTube channel. Just search for I Retire and you will find our channel there with over 190 videos on. Those of you who are listening to Berg Studio, that was Prime Circle, and she always gets what she wants. What an amazing band that was. Yes, interesting story. The lead singer of Prime Circle actually worked in a coal mine just outside of Witbank. And if I have my story straight, I think my brother actually took his position at the coal mine when he quit to start his career as a musician. So yeah, interesting story. Anyway, so let's continue with our discussion on should we cancel our life insurance. So let's talk about why the average person would rather insure their car and household goods than their own life, and how I explain it to people the importance of having their life insurance in place. I always talk about the goose that lays the golden eggs. Now, we all know the story about the goose that lays the golden eggs, but let's say you had a goose, and every morning that goose laid a golden egg. you could then go take that egg, sell it, take the money, and then purchase and buy whatever it is that your family needs. Pay for the house, pay for the car, pay for all of these things. Now, if you had to insure something, would you insure the eggs that the goose was laying, or would you rather insure the goose? Now, the logical answer is obviously you would insure the goose, because if the egg gets broken or the egg gets stolen, the goose will just lay another egg. But what do we do in our personal lives? You are the goose. You are the goose that lays the golden eggs. You created everything you have in your life at the moment. You created the house that you stay in. You created the car that you drive. You created the furniture from your efforts. But what do? We insure all the eggs, but we don't insure the goose, or we don't make sure that the goose is properly insured. So don't make that mistake and insure the eggs, but not the goose. Okay. Now, my colleagues know that my take on financial planning is simple. It's all about the income. There I agree 100%. It's about what is the income that needs to be replaced. Life assurance is no different than investing. The only difference is that with investing, the planner gets the benefit of the fruits of investing. With life cover or death cover, the survivor of the deceased experiences the benefits of it. So why do I say planning is all about income? It is simple. The income requirement under all circumstances, whether it be retirement, income for the family should you die, or taking a sabbatical, will be the driver of how much investments and how much life cover you need. So math time again. So he says the rule of thumb is that for every 10,000 Rand income you require per month, you need approximately 3 million Rand in capital, if we base that income at 4% per year against the capital investments. That means your capital, you take 4% of your capital as a monthly income. 4% per annum. So on 3 million, 4% will give you 120,000 divided by 12 will give you 10,000 Rand a month. So that's where he gets the 10,000 Rand per month. Inflation is assumed at 6%, and the intention is that the capital will be preserved for approximately 20 years. So that is a very difficult or a calculation that needs to be done. We just call it the rule of 300. So if you want to know how much income or how much capital you need to generate a specific amount of income, of how much income you can get from a specific amount of capital, you just multiply the income by 300, or you divide the capital by 300, and that will give you the sustainable income that you will be able to take. And that's why I say most people overestimate the value of capital. They'll go, well, if I pass away, my wife will get 6 million Rand and I'm worth more dead than I am alive. That is not true. You are not worth more dead than you are alive, because we are not taking into account the ability you have to generate income. If your family gets 6 million Rand, then they still have to pay the debt of 2.5 million Rand. That leaves them with 3.5. They have 500,000 to go to to be invested for the kids, which leaves your family with 3 million. That's going to give your wife a 10,000 Rand a month income. If you are earning 60,000 Rand per month, you see the problem. She's only got 10,000. You're earning 60. She's 50,000 Rand short. So if you are earning 60,000 Rand a month and you just look at your income ability over the next 20 odd years, you are worth at least, 18 million Rand just because of your income. Okay, so if any of the variables change, then the required capital amount will change. If the income term is shorter, or if the capital preservation is not important, then the required capital amount will reduce. The required capital amount will obviously also be affected by investment returns. The more conservatively you invest, the more capital you require, and vice versa. So when they talk about the capital preservation is not important, that means that over a 20-year period, you will use the capital as well as the income from that capital. So that means that in the first scenario where they use the rule of 300, at the end of the 20 years, your initial 3 million capital will still be there. If you don't preserve that capital, that means at the end of 20 years, that capital is gone. You're sitting at zero. So that is the difference between having it preserved or not preserved. In the event of death, the same formula as above can be used. However, outstanding debt and death expenses, the executive's fees, estate duty, etc., must be taken into consideration and added to the required capital amount. So this is what we do when our risk specialists sit with you as a client. They will work through these calculations with you to come to an exact amount of life cover that you would need, including the debt that needs to be paid, the amounts to cover your estate costs, any other needs there might be in the event of you passing, as well as the income your family would need moving forward. If you have a strong investment base, that will cover all of the above. Then you don't need life assurance. So what they're saying is, if you have assets that generate income for you without you having to work in those assets, for example, you have 5 properties, those properties generate rental income. So let's say your family needs 30,000 Rand a month, but you are getting 10 or 15,000 Rand per month from your rental properties. Then you only need to make provision for the other 15. You don't have to make provision for the whole 30,000 Rand per month, which means you can reduce your life cover accordingly. And this is what we strive towards. As we work with clients, we want to increase their assets that generate income. And while we're doing that, we are reducing the life cover need. And as that life cover need reduces, the money that you were spending in life cover, you are moving into more investments. On the flip side, if your investment base does not cover all the potential expenses mentioned above in the event of death, then you know how much life cover needs to be either retained or taken out. So I just want to move a little bit back to the question that we had with this family saying that they want to cancel their life cover completely. I believe that you will never not have a need for some life cover. It will reduce over time, but I don't think it will ever get to zero because there will always be some need for life cover. So in this client's case, I would suggest they have a proper risk assessment done with a risk specialist, and then have a look at what they need. They will, with a 10,000 Rand a month life cover premium, they will probably be able to reduce that, but I wouldn't take it to zero. Unfortunately, in most instances, death is unpredictable, and generally, we just do not know when we are going to die. If we did, planning would be much easier in the planning world. We always work on the assumption of today. Yeah, I always say to people as well, when we set these goals, I don't care if in 6 months' time your house is paid off. I don't care that in a year's time the kids will be out of the house. When we look at the goals, we say that if this happens today, what is the need? If it changes, we reassess. And this is why it's so important to have a close relationship with your risk specialist so that you can adjust these goals as they go forward. I always say to people or clients that when we build a relationship with you, there's responsibility from both parties in this partnership or this relationship. The risk specialist or the advisor's responsibility is to keep you informed of anything external that might have an effect on your planning. Legislation changes, tax changes, there's new products, new structures that can be used to optimize the way that you do your risk planning. But your responsibility is to let your advisor or your risk specialist know about anything internal that changes in your situation. You buy a new car, you buy a new house, you get married, you get divorced, you change jobs. Any of those things that changes the planning for today. And if one of those things happen, you need to let your advisor know. That is your responsibility in this partnership. So it's not just a one-way responsibility where your broker phones you every 2 years and tries and sells you another policy. It has to be a joint responsibility, working together to make sure that your things are in place. In other words, if you die today, how will your capital base shape up? He says, I hope I provided some indication or assistance to help you decide whether you should cancel your life cover or not. If you are still in the dark, please drop me a line and I will gladly assist. Okay, so my advice would not be, well, I hope I provided you enough. My advice would be, do not cancel your life cover until you've done a proper risk assessment with a risk specialist, looking at your situation, looking at your needs first, and then restructure your life cover to make sure that those needs are met completely, and then see if you have a monthly savings, and then you can use that savings to invest or doing something with. Guys, I hope that has given you some insight into this question. Just another topic is, a lot of people I get to they ask the question. I think we've answered it, but I want to specifically answer it, where they say, well, if I don't claim for this, then I've paid all of this money. Can't I get something back from my risk cover? Is it only risk, so I lose everything if I don't claim? And the answer, short answer, is yes. Risk cover is pure risk cover. You pay for the cover, you are covered for that month. If nothing happens, the money's been paid to the insurance company, they win. How I explain it to people is, it's like a gambling arrangement. You and the insurance company sit around a table and you say to them, listen, I think I'm going to die this month. The insurance company says, well, we don't think you are. You say, no, I think I'm going to die. I'm willing to bet 1,000 Rand this month that I am going to die. What are the odds that you are willing to give me? The insurance company then looks at it and says, listen, we will give you 3 million Rand for your 1,000 Rand if you should die this month. Do you want to take that bet? And you go, yes. You put your money on the table, and the insurance company puts their money on the table. You go through the month, and lo and behold, you don't die. The insurance company then says, fantastic, we will take our 1,000 Rand. Would you like to take out that odds again, or take that risk again? And you say, listen, I'll take that bet. Here's another 1,000 Rand. I think I'm going to die this month. And you continue until the day that you actually win and the insurance company loses. I know that sounds terrible because you just died, but you then win that bet, and that's when the insurance company pays out the money. They don't come back and give you some of that money back. That is not how insurance works. Yes, the marketing guys can structure it in such a way that they make you believe that if nothing happens, you will get some money back. It is not how it works. I don't care how many bells and whistles and bow ties they put on it. It's not how it works. So risk cover is risk cover. You pay for it, you don't claim, you don't get the money back. So you want to always manage that to keep it as low as possible. So a lot of people say, yeah, but now I'm paying this. Can't I rather invest that? And then if something happens, I have the investment. Guys, again, the problem is we don't know when these things can happen. It is what if. Death can happen tomorrow. It can happen in 40 years. It can happen in 60 years. We don't know what's going to happen in the future. So let's say you do cancel your insurance and you just invest money, and you live until 90. You have no major medical problems. You have no major disabilities in this period. You will be able to look back and say, you see, I proved the theory right. I benefited from not having that life insurance. And people will say, you see, this guy did the right thing. But just as easily, something can go wrong in 6 months. And then people will look at you and say, you were really stupid. Why did you do this? Because most of the time, you don't have the time for this money to save up to that amount of life cover. If you look at most life cover premiums, and you look at what you are paying for the amount of life cover that you are getting, you can go and do the calculation of how many years would you have to save or pay that money before you've paid in more money into that life cover than you are guaranteed to get out of the life cover if you pass away. And I promise you, most of the time it's hundreds or over 100 years that you would have to pay that premium. So you will never pay more into your life cover than you are guaranteed to get out. Okay, guys, so do not just cancel your life cover. If you think you are overspending, if you think you are overinsured, because this is also something that we see a lot, where people are overinsured on one area but underinsured on another area, so we need to just balance it out. But if you feel any of those things are your case, then get in touch with a risk specialist. Contact us, WhatsApp me. We will get somebody to do a risk assessment and make sure that your cover actually addresses your needs. Guys, have a great weekend, and I will see you again next week, same time, same place. Have an awesome weekend, an awesome rest of the week, and cheers everyone.
Financially raw, real, authentic wisdom with Lourens from Retire Rich and Happy.